Okay, everyone, welcome back again. Real quick, I want to mention the fact that we don't really talk about geopolitical events. We are not a in the market, out of the market, or even react much to real quick events. However, we do talk a lot about the overall volatility of the market, and there has been a lot just in the past 48 hours. And we thought it was a little important that even though there's been a ton of volatility here, to at least talk about it and why it's important maybe to stay the course. And again, that old adage saying time in the market, not trying to time the market. So there are two topics real quick that I want to send over to Phil. We've heard a lot, both positive and negative, with Greenland. And then the bonds. The bonds have been going all over the place over the past week. And I'd love to see and get Phil's take on what's impacting what and where we're going with any of these.
Sure, Aaron. Morning. Um, as background, I think it's important to remember two things. One, the stock market has been maintaining some pretty high valuation levels. And as we've consistently said, high valuation levels do not guarantee a market crash. But what it does pretty much guarantee is that when the market gets some negative news or what it perceives as negative news, it's probably going to be weaker than it might be if it weren't so highly valued. So when we get investors seeing headlines about punitive tariffs on Europe unless a deal is done on Greenland, some people will react and be more aggressive sellers. Here we go again, more tariffs. Obviously, that's not in place. And obviously, we know now after 10 months that a lot of the tariff threats are threats and they get ratcheted down and negotiated to something reasonable. But again, the message is that highly valued markets are more susceptible to bigger declines. But the interesting thing is that the U.S. involvement with Greenland has been going on for 150 years. Andrew Johnson tried to buy Greenland and Iceland right after we bought Alaska. During World War II, we basically ran the country's defense because Denmark had been occupied by the Germans, and so Denmark couldn't provide the security for Greenland, so we did. And ever since then, every single president has had some attempt to either negotiate additional installations there, negotiate purchase. It's all been going on for ever since World War II and even before. I think probably more more pertinent to yesterday's negative volatility is what's going on in the global bond markets. It started in Japan. Snap elections were called, and it's perceived that the objective of cutting taxes and increasing government spending in the face of 3% inflation will create more inflation and eventually higher short-term rates. So the bond market sold off, depending upon what portion of the yield curve you look at in Japan. Some are at all-time highs, some are at multi-year, multi-decade highs. So what does that do? It makes it more expensive for the carry trade, meaning investors that borrow yen and pay interest and use that money to purchase securities or commodities elsewhere in the world. It makes it more expensive. The other piece of that is it's nice to have a weak currency while that's going on. The currency's continued weak, at least so far. So that's not the important part of the question. The key thing is that interest rates are going up and short-term rates may go up as well. So bottom line is we would guess that some of the carry trade got caught off balance and maybe some of that was unwound. There's no statistic that we can point to today to say how much of that occurred, but that's the most likely culprit for the volatility of yesterday and the fact that valuations are relatively high made it probably worse than maybe it might otherwise have been.
Great, that's good to know. What it all does lead to is, again, that time in the market versus timing the market. We are fundamentally driven, and basically over the past week, fundamentally nothing has changed. So we have not changed any of our opinions on anything. It does bring up the Fed. The Fed is an interesting point that's going on right now. I think GDP now has a forecast of over 5%. And, Bob and Phil, I'd love to get your opinion on, with such a nice number, should we still be lowering rates? I mean, what do the stats tell us? Which is always interesting to figure out what the stats say versus what actually happens.
Yeah, well, the GDP now statistics are black box, and it takes one of the inputs is imports and exports, which is a key factor in calculating the GDP. So when exports go up, imports go down, those are positive influences on our GDP. And all we have to do is look back at this last year, and we'll note that in the first quarter of 25, imports rose significantly as front running of tariffs. That negatively impacted GDP. In fact, we had a small negative number. In the third quarter, that strongly reversed, and we had a strong GDP number. Net imports and exports were reported for October, which indicated further improvement in the trade balance. That number went straight into GDP now, which took the number from 3.5, I think, to 5 in their forecast. If you look at the New York Fed GDP forecasting model, it's less sensitive to month changes in some of the inputs, and it's at, I think, 2.8, 2.9. So, all of this happening with the backdrop of a relatively firm consumer market that underpins 65% of our economy. So you take the stable consumer spending that we've experienced, and then you throw in this volatile import and export number, and you will get some pretty dramatic swings, which you have to take with a grain of salt.
Yeah, I definitely think that's true. Do you think that the GDP number is being affected by the fact that we're still just now getting some of the numbers that we missed during the shutdown?
No, I think the inputs for the GDP models have been pretty well reported. We may be missing some November, December numbers, but the retail sales numbers are there. Exports, imports, at least through October, are there. So some of the key components are there. And the things that we're missing are more statistical items like inflation, the PCE numbers. We're going to get caught up with 2 months worth here this week, which will be interesting, which could impact how the Fed reacts. A lot of people say that the economy is so strong, the Fed should not be cutting rates. We tend to agree with that because every time the Fed has cut rates in the last 18 months, long-term rates have moved higher. And now we have the 10-year at 4.29, up 10 basis points in the last week, sort of following Japan, but still we're up from the low threes when the Fed started cutting interest rates a year and a half ago. So the yield curve is steepening. The market is pricing in higher inflation over the longer term. So the Fed is playing with fire a little bit if they're going to cut rates further from here.
Great. Perfect. Now, I want to touch real briefly before we go here on something that Bob ran into the other day that we thought was very interesting. Now, we've talked a lot about concentration of the markets. Now, Bob, you went and looked at the Mag 7 versus the rest of the market. What are some of the things that you found out there?
I'd be happy to talk about this, Aaron. Last year, the S&P 500 was up about 17.8%, and that's a cap-weighted index. So the larger some of these companies are, have a bigger impact on the return of the total index. If we look at the 500 equally weighted stocks in the S&P, that was up 11.4%. And there's 10 stocks in the S&P that account for about 39% of the total index return or movement. But let's focus on the Magnificent Seven for a minute. So the S&P was up 17.8% last year. These 7 magnificent stocks accounted for 7.1% of the 17% return. And the other 493 stocks were up 10.7%. And at the same time, in that 493 stocks, there were some stocks up over 100%, but their market cap weighting of the index wasn't significant enough to cause much of an addition to the return. And what's even more interesting is that if you look at Google and you look at NVIDIA, those 2 stocks last year accounted for almost 5% of the 17% index return. Those 2 stocks. And so if you didn't own those 2 stocks or those 7 stocks in the Magnificent Seven and have them in the similar weights to what they are in the index, there's no way many investors ended up with a 17% return. So,
yeah, it's interesting. We're starting to see a little bit of that unwind. Some of the high flyer stocks actually topped out in December and have been underperforming the market. And I think everybody's aware that small caps, for example, have done very well in the last week of December and so far this year. That's not unusual to see small caps turn at the beginning of the year. And it'll take more time to see how what kind of legs that has, but it's definitely turning noticeably this year.
Yeah, it'll be interesting to see how that all plays out. You know what? I appreciate everybody taking a little time just to hear some of the things that we see going on here in the market. Again, we are fundamentally driven. We are still fairly defensively positioned, and we are still fairly short in duration on our fixed income side. Nothing has changed for us over the past week or so. So stay tuned. We'll be in touch if we see anything else change. And again, I thank everyone for giving us a little time today.